Good afternoon, everyone. This is Mark from RightLineTrading, and I appreciate everybody coming out this evening to attend this webinar. We have a really nice turnout. I really appreciate it. Just a little bit about myself. I'm a graduate of the University of Pennsylvania, former professor at Jefferson University in Philadelphia, and I've been involved in the financial markets for over 20 years. And I began trading the futures and forex markets about 10 years ago. As part of my training, I was involved in the optimization of software systems, and I did my thesis on the optimization of underwater dives in collaboration with the U.S. Navy. The University of Pennsylvania has one of the leading underwater decompression departments. There's a name for that that type of it's on underwater physiology. I can't remember anymore what they call that that division, but they work a lot on deep dives and the physiology of decompression. And up till that time, this was way back in the 70s. Computers were just coming out, and for the first time they were being used to optimize multivariable equations. But what happened prior to this was that deep dives conducted by the Navy were, better put, that when the Navy would look to change the way a diver came up from a deep dive, there are three gases involved: oxygen, nitrogen, and then an inert gas. And the mixtures have to be constantly changed as the diver gets shallower and shallower and has to stop at periodic intervals in order to give the gas mixtures time to equilibrate with his blood. So this has always been done by trial and error. For the first time, we used a computer to create a multivariable equation using all of the physiological variables that we felt were important in creating a best dive scenario. And when I got involved in the futures and financials markets, I applied that similar type of strategy to predict the price of the financial markets. Price is really just dependent on a series of independent variables, and if you place those in a multivariable equation and optimize it, you can come up with a pretty good determination of where future price is going to move. And what I really wanted to talk a little bit about was the fact that consistently 90 to 95% of all day traders fail. And it's an interesting statistic because people have been day trading for a significant period of time. I think it's been in widespread practice since the late 90s, early 2000s, where we had the electronic equipment necessary in order to day trade. Yet that statistic remains unchanged. And I believe that the reason is because if you do a Medline search, actually if you do a Nexus Lexus world search for any real scientific papers, mathematical analysis to look at whether indicators accurately have predictive value, you find that there's almost nothing created in the literature, and that people don't approach day trading as a science. And in other words, most of the principles that you have been taught have never been have never been tested in any mathematically rigorous manner. I mean, you're told that a stochastic oscillator works, but there's no scientific evidence for that, because no one's tested it. So all the people who are selling software really have not done rigorous testing of their entire software program or any of the individual components to determine if there is any statistical validity to the type of entries that they offer you. And that's the reason why 95% of day traders continually fail. That's because every few months a new generation of day traders come into the market and are taught the same material that the last set of day traders used to bust out their accounts. Nobody questions the information that they're told by these so-called market gurus who are selling them software. I mean, nobody asks, how is the industry evolving in a way that creates new trading paradigms such that that 95% statistic starts to fall? I mean, so that we learn from the last generation of day traders who failed what it is that caused them to fail. And that's the thing that nobody does. We simply trade the same software packages that have been out there for the last 15 years and created money for nobody, and they continually get upgrades, but we don't know that the core system has any mathematical validity, and we just all walk off that same cliff like lemmings. And that's the thing that we didn't want to do here at RightLine. We didn't want to take anything as being a priori effective simply because we were told it was effective. And I wanted to give you a couple of examples of that. I've seen a lot of software packages that trade Renko bars. You use a stochastic oscillator. Now, all oscillators really are just derivatives of the same equation, and they require 4 parameters. They require a high, a low, and an open and a close of each formation. And the formation can be a candlestick, it can be an open, high, low, close, it can be anything. But they must have those 4 numbers to plug in order to trace out an accurate percent K. Now, this is an 8-range Russell chart from May 14, and you can see that on a normal range chart, you have a high, a low, and an open and a close. So this percent K line, the gold line, is tracing out an accurate percent K. But here's the stochastic on a Renko chart. And there is no open and close. There's simply a high and a low. So what happens is the formula defaults. It takes the high as the open and the low as the close. And it creates a percent K line that just traces out price and has absolutely no predictive value whatsoever in creating more precision for your trading entries. It's useless. But I see it offered up over and over again on packages that you pay a large amount of money for and are told that this stochastic indicator is going to help with your entries. And that's because nobody looks at the underlying formula and what it requires in order to function properly. Now, the other thing about an oscillator that led us to question whether or not it has any value whatsoever is the fact that groups of traders use it differently. Now, this isn't true of other indicators, but it is true of the oscillator indicator. Now, some traders look at the oscillator, and when the oscillator is overbought, they consider the bulls to be in charge of the market. And what they do is they continually to buy each pivot as it's broken to the upside. So they use the overbought or the oversold signal to continually buy the market to the long side or continually sell it to the downside when the market is oversold. Then there are the groups of traders that look for stochastic divergence. In this case, here you have price making a higher high and RSI making a lower high. They're looking to short, and you can see that the signal just gets run right over. So really, in order to determine who's right, is it the traders that continually buy an overbought market and sell an oversold market? Or is it traders that continually look for stochastic divergence to take a reversal trade? So what we did is we placed 2 years of data, of market replay data into NinjaTrader and looked at the statistical validity of an oscillator signal. And what we found is that both groups of traders are right and both groups of traders are wrong. Because the fact is that the oscillator in and of itself in no way is able to predict future price movement. It has no statistical validity whatsoever. That stochastic divergence gets run over so many times and makes trading the signal useless. And continuing to buy a higher and higher pivot fails so often, it makes that strategy also useless. So what does that do for the actual stochastic indicator, whether it's relative strength, or for the oscillator indicator, whether it's stochastic, relative strength, the CCI, the Williams K, which I see people touting and selling. What it does is it renders it useless. And we have proven mathematically that although the oscillator is an elegant idea and it traces out a neat-looking line, if you're going to use it to try to increase the precision of your trades, it isn't going to help you. Now, the other indicator that we looked at them all, we looked at Fibonacci. And Fibonacci is a strategy. It's an analysis of price movement. And Fibonacci was born, I think, we lived in the 17th century, I think. And he was a mathematician that described Fibonacci numbers, Fibonacci transformations, and they're really quite neat if you play with Fibonacci numbers. The transformations that you can do on them actually are pretty amazing. The thing is, when he created these numbers, the stock market wasn't around, and what he found was that what they describe in nature is really quite trivial. The number of edges of a snowflake, the number of ridges in a pine cone. But some bright guy got the idea of taking a 300-year-old set of numbers and deciding that the stock market is going to respect, Fibonacci extensions and Fibonacci retracements. Now, for the life of me, I have no idea why anyone would have considered this to be true, since he didn't create the numbers to use in the stock market, and they really don't do anything of utility in nature. I mean, they're very elegant mathematical equations that describe the movement of subatomic particles. They're really elegant formulas in quantum mechanics that do describe the interaction of small particles, the interaction of large masses, but the Fibonacci numbers don't do a thing. So what we did was we did the same thing with 2 years of market replay data. We looked at the precision by which Fibonacci levels hold or break. If they hold a high percentage of the time, very high percentage of the time, then they're going to be able to increase your trading precision. If it's a toss-up as to whether or not they break or they hold, then they lose their mathematical validity. And what we found is that it's really pretty much a toss-up. I mean, again, Fibonacci in no way predicts the future movement of price. And I have seen all these elegant Fibonacci charts laid out, and they all have multiple scenarios, and you know they all have these zones and those zones. But what you're going to find is that, and you may have already found, is that zones in day trading don't work. You need a precise numerical entry number. You can't trade areas. So Fibonacci numbers are absolutely worthless, and if you use them, they're more likely to mislead you than they are to point you in the right direction. They just do not work, and it's something that we have proved. Now, I don't have a slide for it because we just did it recently, but the last indicator that we analyzed was the MACD. Now, you would think that the MACD would work, that a MACD crossover would have some significant mathematical validity, in that a crossover to the upside would lead price to move up. A crossover to the downside, you know, when the signal line crossed the slower moving average, you would get a move to the downside. But the fact of the matter is, and what we did was, we did the analysis using one set of MACDs on our trading chart, and then we did it with 4 MACDs, looking at multiple time frames and waiting for all the MACDs to turn in the same direction and try to predict how future price movement would work, and they just don't have it. They just don't work. Price on your trading chart in no way is affected, or does the MACD have any mathematical validity in increasing the precision by which you trade. And this is really the basis for that 95% failure rate. Almost everybody uses some variation of an oscillator, of MACD, or Fibonacci. Now, they're much more elegant indicators now. There's order flow, there's market profile, there's volume profile, and we believe those have a lot of validity, which you'll see, because we've tested those and those work. But a lot of people use these to trade, and these are what are going to lead to failure. What the key is to determine what independent variables are actually responsible for moving price on your trading chart. Fibonacci extensions or retracements don't move price on your trading chart. The oscillator doesn't move price on your trading chart, and neither does the MACD. So what's the predictive value of any indicator that assimilates data from your trading chart only? And here's really one of the keys to it. No matter what the indicator is, if the indicator uses the data from your trading chart only, it has no predictive value whatsoever. And it doesn't matter what the indicator is, including more elegant indicators like volume profile, market profile, and order flow analysis. So a lot of basic indicators have to be eliminated. Now, we looked on MACDs at multiple time frames, and they still don't work. But the bottom line is, if an indicator uses data from your trading chart, it's impossible for it to tell you where price is going to move in the future. Now, listen, a price moves according to market sentiment. That's market structure, that's price action, that's moving averages, and that's what part of the MACD system is. But the fact of the matter is, there are other independent variables responsible for moving price, not an indicator based on price on your trading chart. And indicators like the oscillator and Fibonacci and MACD will not work. And this, again, why 95% of day traders fail. They consistently use the same systems that have the same foundation and don't question whether or not they really work. So what we've done, and I mean, this is really a slide I should come back to, because what I'm going to show you is what we have found to be true independent variables that actually do tell you the future direction of the price movement. with a high degree of precision. Now what this pink is, and I'm going to show you our trading charts in just a short period of time. This pink is created by not looking at any price on the trading chart, but by looking at the trend on your two higher time frames. So on a 5 range, it's looking at the two higher time frames to crude. Now when the two higher time frames are both moving to the downside, and they have broken all support to the downside, and the 50 is moving to the downside, and our proprietary, we call it our modified 15 is moving to the downside, you then get pink on your trading chart. So with your two higher time frames moving down, you've got your 50 and 15 moving down. You have no support to break to the downside. Price on your trading chart is very likely to fall. So if you're going to take a trade, this doesn't give you an entry, it gives you a bias. And that's why the indicator itself is called right line bias. So your bias during a period of pink background is strongly to the downside. You're not going to trade against a pink background. So when you find an appropriate entry, it's always going to be to the short side. Now this is a true independent predictor of price. Here, price isn't falling. The pink background is not caused by price falling. Price is falling because the background is pink. And that's the way and that's just the opposite of what you see it on most other trading charts. As the price falls, the background goes pink, or it goes, into a color that demonstrates down bias. And that's true of every single paint bar I've ever seen. Price has to fall, and then the paint bar turns red. Well, that doesn't give you any independent statistical validity at all, just telling you what price is doing. This is an independent variable because it doesn't look at the price on your trading chart, and it is generated by price movement on your higher time frames. This really helps your trading precision. Now another indicator that we have is called a right line quant analysis indicator. Now the other indicator looked at two higher time frames, and this indicator looks at different markets that correlate, that have a correlation coefficient with bonds of 0.7 or greater. And in order to really understand the quant analysis indicator, you have to look at what happens in the course of a given day. And for the most part, all the money that is traded by institutions is just rotated. I mean, the financial institutions rotate it. When risk is on, they're in stocks. So you have the NASDAQ, you have the Dow, you have the E-mini, you have the Russell. You have stocks going up. Now, if stocks are going up, they're pulling their money out of all the safe havens like bonds, notes, precious metals, other financial instruments. So really what you get really is sector rotation. So what we look for is what markets correlate with bonds with a correlation coefficient of 0.7. That means 0.7 is 70%, which means that if bonds go up, those markets go up at least 70% of the time in concert with bonds. Now you can also have a negative correlation coefficient, and those markets go down when bonds go up with a coefficient of 70% or greater. So what these quant lines are really telling you is where the money is going. And when each of the lines is comprised of 3 markets, so there's 6 markets in each line, so that when both lines are green, it means that money is flowing into bonds. So these lines aren't green because bonds are going up. Bonds are going up because these lines are telling you that money is flowing into bonds. Now, because the correlation coefficient is 70% or greater, there are going to be times when bonds go up on a neutral color. There are going to be times when bonds might rarely go up on a red color, which is very unlikely. But when both lines are green, I don't want to say it's almost guaranteed, but you have a very, very, with a tremendous degree of predictive value, the financial instrument you're looking at is going to rise. And again, the green lines are not caused by the rise in bonds. The green lines cause the rise in bonds. That's what makes this a totally independent variable and extremely helpful in determining the future price movement of bonds or any financial instrument where we have quant lines. We have them now on many, many, many markets. Some markets we have 3 lines because we have 9 quantitative markets. Others we have 2 because we have 6. And some we only have 3 markets, so we only have 1 line. Now here's another indicator that we found very helpful. Now we use market profile. We don't use volume profile, we use market profile. And this is the value area high, this is the value area low, and this is the point of control. And just briefly, for those of you that are not familiar with it, basically what it is between the value area high and the value area low is 1 standard deviation. Almost all VALs and VAHs comprise 66 2/3% of all volume that is crossed on any given financial market in the course of a day. The point of control is the price where the most volume is crossed. So this is where price likes to sit. This is where most, per any given individual price, this is where more buyers and sellers sit. Buyers and sellers sit here, and buyers and sellers sit here. So these areas act as strong barriers, act as support and resistance, to put it easily. Now let me put it to you this way: the market has defined that the fair value for crude is between these 2 lines, between the VAL and the VAH, value with the VAH and the VAL. This is what the market has decided comprises 66 2/3% of all volume, or to put it another way, this is the fair market price for crude, anywhere in between here. Now, if it breaks out above the value area high, crude is more expensive than it should be. If it breaks below the value area low, crude becomes cheaper than it should be. And you learn a lot from how price behaves as it breaks above or below the VAH or VAL. Now, not all market profile indicators are the same. Now, every market profile indicator has the same point of control, because determining what price has the most volume is really quite easy. But determining the VAH and the VAL, almost every indicator is different. Now, I said that it's 66 2/3% because that's by convention, but most market profiles have the VAH and VAL set between 66 2/3 and 70%. And actually, there's an in-between number that's optimal. And the way we determined it is by doing a year of market replay data. We looked and found what we consider to be the optimal number to separate the VAL from the VAH. And it's not 67 2/3%. The other thing is, if your market profile simply uses the data from your trading chart, when you open it in the morning, there's going to be very little accumulated volume. And volume profile or market profile is going to get shoved around a lot. Now, if you look at a lot of people that use volume profile, you see they use a daily volume profile, a weekly market profile, and some even a monthly market profile, because they understand that whatever occurs in a single day may not be particularly powerful. Now, we can't do that with market profile. We can't have 3 lines or multiple lines. It would drive us crazy. So what we did was we do a proprietary number of day look back. So you get stability with market profile even from the moment you open it. It doesn't get bounced around by price. But the look back isn't so far that the lines are overly stable. Like, they don't move. They do move with price. And the third thing that really makes the indicator unique is that these lines move intra-candle. And most market profiles make an assessment at candle close. And what happens sometimes is you'll take a trade in which you don't have a value area high in front of the trade, and then as soon as the candle closes and you're in the trade, the value area high jumps right in front of your trade and creates an area to the upside of tremendous resistance or to the downside of huge support. You don't want to be in that trade anymore. This tries its best to avoid that from happening. And that's what makes it unique. And what we do is, this is exactly, we take a break, and then a pullback to support, and then a move up. Or a break, a retest, and a move up. And then you see how this tested the point of control twice? We take this short. So you can get great trades just using market profile as areas of support and resistance. We never take a first test. We always take a double test. So it's got to come down, test, and then retest support, and we go up. It's got to come up, test resistance, retest resistance, and we're into the downside. And it acts as a great indicator for predicting the future movement of price. Now, the other thing that is a huge independent variable that a lot of programs don't even look at nor feel is necessary, and that is looking at price action. Now, market structure is defined by your moving averages, your 50 and your 15. Now, you can use any moving averages you like. The faster you use them, the more sensitive they're going to be, but the less specific they're going to be. And I'm going to go into that in 1 minute. I don't want to confuse or overwhelm you with numbers, because a lot of these, I mean, they're important to understand, because they're going to give you the rationale for how you have to trade and the right way to day trade. But this is the rationale for how you have to look at consolidation. Here's the 50 is down and the 15 is down, so we're in a confirmed downtrend. Now, unless the market is oversold and we have a different parameter that we look at to determine whether a market's overbought or oversold, this market is now in consolidation. And what consolidation does is, a lot of people, when they explain consolidation to you, they explain it as, well, there's a drop-off in volatility, and eventually, you know, as long as volatility is low, it's eventually going to explode out. It's like a coiled spring. And the tighter you coil it, when it releases, it's going to fire out price. But we look at it differently. What we look at is this down candle contains a preponderance of sellers. This up candle contains a preponderance of buyers, a preponderance of sellers, a preponderance of buyers, a preponderance of sellers. So you've got all these traders trapped. Now, if the trade moves to the upside, it's going to stop out all the sellers. If the trade moves to the downside, it's going to stop out all the buyers. So the reason that price fires out of consolidation is because it moves out of consolidation with two forces: the addition of new sellers and stopping out all the traders that are in a counter trend candle, which is not a good place to be. And we have a consolidation signal. So trading consolidation in the direction of the trend is incredibly profitable. And we have a consolidation entry that calculates the number of candles in consolidation, the high and low of each candle body, and we've defined what we consider to be an optimal a set of optimal consolidation parameters. When consolidation moves tight to resistance to the downside or support to the upside, it's going to break. Now, it's going to either break to the upside or break to the downside. It almost always breaks in the direction of the trend, unless it's just moved considerably. And I'm not going to go into that parameter, but we have a separate parameter that defines, again, overbought, oversold. So what you're going to do is, as soon as you see the signal intra-candle, you're going to put your entry one tick below the close of this candle, and you're into the downside. You've got yourself a really, really nice move to the downside. So the system actually analyzes price structure, which is a very, very important component of taking a trade. Now, there was one other, I just wanted to, I'll find it on our trading chart for you. So our goal and our trading methodology is to do a multi-time frame analysis of market structure and a multi-time frame analysis and a multi-frame indicator analysis. Never look at anything that simply looks at data from your trading chart alone. That's only going to mislead you and have no future predictive value. And then place that into a simple platform that's been, I forgot the T, but it's been optimized mathematically to provide you with remarkably accurate trading entries. All you need is discipline and patience. You can trade with really, really amazing precision. Now, we do trade tops and bottoms now. And so occasionally we do take reversals. But we don't counter trend trade except for very, very specific instances. We never trade potential breakouts. What we really like to do and what our bread and butter trades are to trade retracements in a multi-time frame confirmed trend with multi-time frame market structure and alignment. And this is what's going to create for you entries that have a very high positive predictive value. Now, before I go on, I just want to, I really should be able to type to make this more understandable, but we're going to go to the trading platform in a minute. So, you see here, this is a consolidation signal right here. And down you go. Here's another consolidation signal. Now you can see our consolidation lines. We have an upper blue and a lower red. Now this only prints when consolidation has been confirmed. On the last candle that's required, you see it flash. And then you're in consolidation. You simply wait intra-candle for the down triangle, and you're in one tick below the close of the candle. And consolidation just gives you great signals. And you can see of our quant lines on the E-mini, we had 2 out of 3 red on both trades. So that we had almost all the correlative markets with us. We had the markets in the last line neutral. But because price structure and price action and market structure were so overwhelmingly positive here, you're going to take this trade. These are just trades I took in the room. And I don't want to go into falling or rising channels, but if you look at the 17-tick trade, what this is nothing more than a strategy entry. So it's an entry I didn't really talk about, but it's a move down, multi-time frame analysis, background is pink. Now the candle is surrounded in red. And what we do is a multi-time frame analysis of order flow and momentum. Now, like I said, we're not big on MACD, and we don't think it works, but it doesn't hurt to have it in your favor. So rather than eliminate it from the indicator and code it out, it's still there. And when momentum and order flow are to the downside on 2 higher time frames, the candle's outlined in red, and that increases the precision of your trade, and down you go. Now, the only time you can actually tell where the value area low is on the right edge. And I can't move the slide over, but you'll see what I'm talking about. You've got 2 out of the 3 quant lines, background pink, order flow and momentum align with you to the downside. You're tight to resistance, just where you want to be, and you get a really nice trade to the downside. On the E-mini, this was 4 1/4 points. Same trade. This is just a retracement, the move down, retracement, strategy entry, continuation trade. All 3 quants are red, 4 3/4 points. Trade to the upside. This is also, again, strategy entry, just a retracement trade, up for 3.75 points. The key, this is very powerful, up bias as well. Not as powerful as the green color, but also powerful. Order flow and momentum with you, all 3 quant lines with you, all of our independent variables that accurately predict future price movement are with you on the trade. To the downside, almost all the quants, order flow and momentum on the candle, down for 3 1/2 points. Okay, now let me just go, I'm going to take the slides off, and I'm going to move to our platform. If I can figure out how to do it, just hold on 1 second. Okay, here we go. Okay, there's our platform. Now, we actually made net $580 today in the room. I assume everyone can see that. So let me just show you on crude. We finished early because we had our price target and we wanted to quit. And I took one loser and I took a lot of huge winners. Okay, here was the first trade I took. And what this was a move up, now we got to go to the right edge to see where the value area high and the value area low are, right here. Here's the point of control, and we're trading through it. You see the candle surrounded in blue. It's a move up, and then the market starts to consolidate sideways. And when it finally really tugs against support, you have order flow and momentum to the upside. I went long. We were in 1 tick above the close of the candle, and the trade went 12 ticks to the upside. And then this is our reversal trade. Now, the reversal trade has to be lots of parameters that I'm really not going to go into that much. But this met all our criteria, and the trade dropped for 14. So we had 14 up and 14 down. And then I took a horrific trade here. This is a break and retest of the modified 15 with the quant line red, but you always want to trade with the modified 15 on the side of your platform. However, you want the 50 on the long. You see how the modified 15 is up? Here, we want this modified 15 to be either just crossing the 50 or below it. This is a terrible trade. And then I took a trade out of consolidation for 24 ticks. And then I took another trade, a break and retest of the modified 15 for 20. On the 24 and 20, we made $800. So that finished our day. And what you can see is that the background bias and the quant line really help you trade. When you've got down bias, you trade to the downside. When you've got order flow and momentum and the candle surrounded, this candle was. Fractal indicators change when you close and reopen the platform, and they move everything over a candle. But this candle was surrounded with order flow and momentum. The only independent variable I didn't have was the quant line, but I let it go because I had so many independent variables in my favor. And here, I just had terrific market structure. I love the trades out of consolidation. I think they're the most powerful. Now, there's one other entry I want to just show you real quickly. And I think we can find it easily right here. I mean, this is an entry. It's a break and retest of the 15. Look at that trade. We were just out of the market. Here's another beautiful short, but we were done. And you see, when you have no background bias and no quant line, the market just loses all direction, and you just stay away. E-mini, same thing. These were two shorts, which we didn't take because I wasn't looking. And this is another loss. I took two losses today. That's why the 580. And this is a perfect short. And that's the only trade I had on the E-mini today. Now, here's what I want to go over with you. And I think this is I think if there's a take-home message, this has got to be the most important. A lot of people want to trade with sensitivity. Now, if you trade with sensitivity, what you're trying to do is you're trying to find every true positive. You want to be in every market move that's going to hit your first target or make you money. I mean, you really want to be in on everything. Now, if you do, now sensitivity is equal true positives over true positives plus false positives. Now, a false positive, obviously, is a loser, where you think it's going to go to your first target, and it doesn't make it. Now, if you trade with 100% sensitivity, there's no false positives, and every single trade you take is a winner. Now, if you try to trade with sensitivity, you're going to go broke. What you have to do is trade with specificity. The specificity looks for true negatives. What that looks for is you're not looking to get into every winner, you're looking to avoid every loser. And that has to be your strategy. If winners go by you because they don't meet your trading criteria, it doesn't make any difference. You're always going to get an opportunity to take a trade that does meet your trading criteria. So you want to trade looking to avoid losers, not looking to get into every winner. Now, a false negative is when you stand aside on a trade and it works. Now, this creates for you a number called positive predictive value, which is sensitivity over specificity. So in other words, your ultimate trading strategy has to find some balance between sensitivity and specificity. But what we do is err way in the direction of specificity. We look for the ability to avoid everything. Now, positive predictive value, and this is what's really important, is not just specificity over sensitivity. It's specificity over sensitivity times a really important number. And in day trading, that number is prevalence. Now, in each scenario, prevalence is different. When are you most likely to get a successful trade? The answer is when you're in a trending market. The prevalence of a successful trade is high. When you're in a choppy market, the prevalence of a successful trade is awful. So what you have to do is make sure your software very, very carefully and with tremendous precision defines chop. If you use very fast moving averages that are whippy and that whip you into trades, you're trading with sensitivity, you're going to yank in a lot of false positives. If you trade with stable moving averages, which is why we created this modified 15, you see when it's yellow, price doesn't move it that much. This defines chop, and we don't want to trade a yellow modified 15. The most important thing to do is stay out of the market during chop and have your software clearly define chop for you. And when it does, stay away. Then the prevalence number is going to be extremely high. And sensitivity over specificity times prevalence, you want to be equal to 75% or greater. If you can't pull in 3 out of 4 winning trades, you are never going to be profitable. That's really the number you have to trade. Now, the last thing I just want to mention is risk to reward. Now, a lot of people, listen, there's no right or wrong to it, but we just have a methodology that I think happens to be appropriate. And I'm not saying it's the only appropriate methodology out there. But you just can't ask the market. We know based on 2 years of market replay data that the average successful trade on crude oil is 12 ticks. So if you set a third target at 25 ticks, you're almost never going to hit it. So you have to have, so your automatic trade management strategy, your ATM that you code into NinjaTrader, has to be based on the way the market moves. It's not that you just put in a number. Well, you know, my stop is 10 ticks, so I'm not going to take anything off until I hit 10. So I have at least a 1-to-1 on target 1. And I'm not going to take anything off, take my second lot off at 20 and my third lot off at 30. Well, that's all well and good, but what you want to do is optimize profit, not set an ATM strategy for yourself that's so huge that it actually degrades your equity curve. And that requires a lot of market replay data, and we redo that every 3 months and reset our ATM strategy because the market changes. And we just changed our ATM a little while ago, and it's helped us out tremendously. So let me just go back to the slide. So what we've created is a system. Now you can, oh, here it is. Now what we've created is what's called electronic entry. Now maybe, now first of all, just a little bit about our methodology. We never ask you to pay for boot camps. Our seminars and lectures are always free. In fact, I did a 1 hour and 45-minute seminar this afternoon at 1. I did a 1 hour and 45-minute last week. Every week, everybody who's a member of our training room, I give them an in-depth lecture on how to trade price action, market structure, what's important. Remember, trading price action and market structure are not easy. And that's, again, why most day traders fail. They would rather just look for a green dot and go long or a red dot and go short. And that's the end of it. But if you really want to be a professional day trader, you have to learn how to read price action. If there was an indicator confluence signal that you could go long on the green and short on the red, somebody would be a trillionaire. Because they would have found some indicator recipe that when it all aligned, you just went long and you're going to win 80% of the time. And the problem is it's never going to happen if you don't create a tremendous respect for market structure and price action, because there's such powerful independent variables in the equation that determines future price movement. And we go over that in detail every Wednesday. Today I had to do it on Thursday, every Wednesday at 1 o'clock after we close the trading room. All our new indicator packages and upgrades are free, and they're just all yours for becoming a part of our family. Now, you have two options. You can come into the room and trade yourself, or you can come into the room on what's called our electronic entry. I want to leave time for questions. Our electronic entry allows me to trade for you, and it's really a revised, revamped, and really a system we put a huge amount of work into. And when I hit a long trade, it's going to trigger a long trade through your Ninja Dome, and it's going to appear right on your Superdome. When I hit a short trade, it's going to hit a short trade for you, and it's going to appear on your Ninja Dome. I hit them early. You have the option of censoring the trade if you don't like it, or you have the option of letting it go. The trade will mature and develop based on our ATM strategy. So I think being present at the time the trades are taken are advantageous, but it's not absolutely mandatory. And we only have 17 slots. We started with 20. We have 3 taken. And for 1 month, it's $399. The best value for the we created for the webinar is $999, and lifetime it's $39.99. And once we hit 20, as people drop out, we're going to add them, because we can't put so many people. Now, the number of contracts you trade on this system is totally up to you. And we can't put people on the system that are going to trade a 10 lot or a 20 lot or a 30 lot and then have 20 people on the system. It's going to create a scenario where no one's going to get filled, or it's going to be very difficult to get filled. And we're going to have a lot of problems with slippage. So that's why we have limited the number, and we really are going to limit it, because it is definitely going to have an effect during times when the market is trading a little thinner, and if somebody decides to trade a very, very large amount. Now, you will receive an email with these prices embedded if you decide to go along. Let me just see if there are any questions here. If I can find them. Hold on 1 second. Oh, here they are. Me, Fitzroy. I'm the one who's calling the trades. I'm taking the trades. I'll show it to you. I trade from 8:45. Well, like tomorrow morning, we're going to open the room early, because tomorrow morning at 8:30, there's a lot of financial data coming out. Routinely, we trade from 8:45 in the morning until 5:30. I'm sorry, 8:45 till about 11:30, and that's when we quit. If we hit $400 or $500, we're going to stop. We're not going to trade on. I mean, we're looking to make $1,000 a week apart from commissions. I'll show you our record going back 3 years. Just go to RightLineTrading and just go to performance, and it's trading room discretionary. And this is our monthly profit. Now we don't have, this is 2014. And the first month we opened the company was the best. We made 98.90. And the first year, we did not take a losing month. It was the easiest year to trade. And in 2015, and this is all after commissions. In 2015, in December, we took our first losing month. We lost 1830. And we made between 6,000 and 2,500 a month. I don't have that averaged. And 2016 has been hard. It's been harder. I have 2 losing months, 2190 and 1970. But we're off to a great start in July. We just haven't brought it up to date for the last. We're up $625 already. And you know, this is our track record going way back. We have drawdowns and we have bad months. Any individual trading day is unimportant. It's really what you do over a period of time. But this is our record. Sure, Fitzroy. What I would do is just to get used to the system. You may want to try it in sim for a few days and see how it works, see how quickly it triggers the trades, and then you can go to live. I mean, your net equity that you get should be very close to what we do in the room. We don't have anything set to fill on touch. Sometimes it's hard to get a profit target. Our net equity should be very similar to yours. So if you have if you have a problem with over trading, if you have a problem with, you know, click hesitation where you're not sure about the trade, then it skips past you. If any of these issues are a problem, plus you're going to see the trades trigger on your dome, and you can mark them, and they're going to mark your chart, in fact, and you're going to see where all the entries are. You're going to learn not just by seeing in the room, but you're going to learn by actually watching the trades trigger. And you're going to get a good feel for what you may consider not to be a great trade. I took one trade today that wasn't that great, but I had, you know, a couple of enormous winners. 2 trades for $800 right after the crude inventory report. 24 and 20 ticks hit our last target of 20 to close the trade at plus 400 twice, and those occurred only about 5 minutes apart. So we shot up $800 in net equity. We trade. Sam, I don't know what Collective 2 is. I really don't. Fitzroy, Leo connects it for you. I can't tell you the technical side of it. I'll check it out, Sam. We trade 4 contracts, Jim. 4 contracts on crude and 4 contracts on the E-mini. Our last target on crude gives you 400. Our last target on the E-mini gives you 350. That's 11 ticks on the E-mini and 20 ticks on crude. But we have a pretty tight trailing stop. So if the trade pushes up, we're looking to conserve profit. I mean, the whole orientation of our system is to stay conservative. We don't want to give the trade a lot of room because we don't want to give back a lot of money if it reverses on us. So a lot of times we may not get to that last target of 20 ticks, but if we make 15 or 16, we'll take it. Because I've seen too many trades go 18 or 19 and then come all the way back and knock us out. And we don't want that to happen. No, I'm going to check that out, Sam. I definitely am. So Leroy comes in and does all the Leo comes in and does all the configuration. And if we make money in the room, you should make money. And that's our track record. And it's a 3-year track record. It goes back a long way. And it just shows you by year. I mean, the market was much tamer in 2014. And in 2015, it got tougher. And we had our first losing month, and in 2016 we've had 2. But I still have, you know, we're in the summer, and this summer volume has been horrible. You know, July 4th week, we did awesomely well, but the volume was really bad. And I think that the closing 4 or 5 months of the year will give us great opportunities to trade. The summer is just tougher. But here's the key to trading a summer day. You simply get less trends, so you have fewer trades to take. If you don't chase the market and you follow all of your rules, you're going to see a green 50 and a green modified 15 and a red 50 and a red modified 15 much less often. So you're going to get the opportunity to take a trend trade where the prevalence of a good move is the highest less often. As long as you don't chase the market and you stay conservative, you simply have to be more patient. That's all it is, because our system defines chop for you really, really well. And to the best of my ability, I try to just sit on my hands and take the most conservative trades I can. So that is this. Yeah, Leo. Thank you, Fitzroy. So that is the system. Like I said, we only have room for 17. We will send you an email, and I hope you'll try it out. Again, if you hesitate to take a trade, if you make a lot of money and then give it back, if you just want to learn how to trade, I'm telling you, our Wednesday afternoon didactic sessions are worth the price alone. I mean, so far I've done 2, each of them were an hour and 45 minutes. And I told everyone an enormous amount of information about price action, market structure, indicator analysis, and how we trade profitably. And it's a very, very different methodology than most other systems. Most other systems work off of analyzing indicators. And even though market profile and volume profile are great indicators, I personally do not believe you can trade with them without a strong respect for market structure and price action. You can't use them alone. And that's just my bias from doing this for many, many, many years. I don't think any indicator can drive you to profitability alone. And we do use market profile, but like you can see, we don't use it by itself. And our market profile does create volume profile. I just remove it because I'm not going to trade the nodes. I'm not trading that stuff. I believe our entries based on price action and market structure are much more powerful than market profile or volume profile. Market profile, I think, is a key independent variable and very important. So that's really it. I don't want to go over time. I know it's late, and if you guys were trading, you ladies were trading, I know it's a long day. You're welcome to give us a call. This webinar has been recorded. We will send everybody who registered a copy, and you're welcome to give us a call and let us know how you feel. And if you want to sign up, just give us a call. I don't think you're going to be sorry. So everyone have a really, really, really wonderful evening, and I really, really appreciate it. That's why we have a 1 month inexpensive option. And if you really like it, you can always upgrade it. So take care. Have a great evening. And no matter what system you trade or whatever you do, I really wish you all, everybody, the best of luck. And let's all be profitable and beat the other guys. We can't beat the institutions. We got to beat the other commercial traders. So let's do it. So take care, everyone, and have a really, really great evening. Thanks for coming. Bye-bye.